Taxes. Imagine this. You've had a very hard month flipping burgers at your local McDonald's. One night, while lying in bed, you receive an email from them. It says you were paid $2,000, but only $1,456 was transferred to your bank account. You look down: federal income tax, state income tax, Social Security, Medicare. This is a modern ritual of giving part of your money to invisible forces, and they expect you to thank them for it. The main point is this: taxes are the price of civilization. You pay. The government builds roads, funds schools, makes sure your favorite taco truck isn't full of rats, and sends billion-dollar missiles to places you've never been. But there are different types of taxes. Income tax, applied to the money you earn. Sales tax, applied to the money you spend. Capital gains tax, applied to the money your investments earn while you sleep. This means the government takes a share of every dollar. Almost everyone also pays Social Security and Medicare taxes. A Social Security is a government program that requires saving money for retirement. You save now and withdraw it gradually when you retire. A Medicare is a health insurance program that supports older people and those with serious health problems. Then comes the tax filing stage. The government knows how much you owe, but it wants you to guess. If you guess correctly, no problem. If you guess wrong, you're in trouble. When it comes to paying taxes, some people pay every few months. Some pay once a year. Some never pay and later become the subject of documentaries. Taxes are annoying, but they are not all bad. In general, countries with higher tax rates tend to have a higher quality of life. Banks. You walk into a bank and give some money to the cashier. They count the money, smile, and say it will be added to your account. Great, you think. My money is now in a vault guarded by a dragon. But in reality, that money is already gone. Most people think of banks as big safes. But in reality, banks are more like intermediaries for financial transactions. When you deposit $1,000, the bank lends $900 of it to someone who wants to buy a jet ski. This system is called fractional reserve banking. The idea is that banks only keep a fraction of the money because not everyone will come at the same time to withdraw all their money. Of course, people tried to do that in 2008, and the system almost collapsed. How do banks make money? By lending your money at a higher interest rate. You are the supply of money. The borrower is the demand. Banks encourage you to deposit money for several reasons. Paying with a card is easier than paying with cash. They pay you interest for keeping your money there. It is safer than keeping it in a safe at home. Most bank accounts in the United States are insured by the government up to $250,000. Interest. Imagine you borrowed $1,000 and have to pay back $1,280. Why? Interest. Interest is like rent paid for someone else's money. When you borrow money, it is a fee for using it. When you lend money or save it, it is compensation for your patience. There are two main types. Simple interest, a fixed additional payment. Compound interest. The interest you earn also earns interest. For example, you don't pay the 20% interest on your credit card. Interest begins to earn interest. One day, a $12 burrito turns into a $50 regret. On the other hand, if you invest with 7% compound interest per year, $100, $200, $400. One day you wake up older, wealthier, and a little more proud. Interest is the hidden engine of both debt and wealth. Inflation. You buy a bag of chips. When you open it, it is half empty, and it costs 30% more than before. That is inflation. Inflation is the loss of the value of money over time. $5 is still $5, but you can buy less with it. Causes. People have too much money. Supply chain problems. A rising production costs. People expect prices to increase. A little inflation is normal. About 2% per year is considered healthy. But if it increases too much, savings lose value. Wages fall behind. Governments fight inflation by raising interest rates. This makes loans more expensive and reduces spending. Recession. A recession is a period of economic decline lasting at least 6 months. One day everything is fine. You have a job and plans. Then, layoffs begin. Markets crash. People reduce spending and buy only essential goods. Reasons: high interest rates, war, pandemics, economic cycles. The economy works like this: boom, peak, recession, restart. Credit score. A credit score is a 3-digit number that measures financial reliability. Range: 300 to 850. Below 580 risky. Above 750 very good. Calculation factors: payment history, credit utilization ratio, age of accounts, types of credit, new credit applications. If you do not make payments on time, your score decreases. Money currency. Money is not physically real. It is simply a system people agree on. The only difference between a dollar and a stick is that people believe in the dollar. The government prints money. Central banks regulate it. People exchange it for goods and services. Investment. The best way to fight inflation is investing. Your money works instead of sitting idle. Main types of investments: stocks, a small share in a company. Bonds, lending money to a government or company. Funds, a mixture of different investments. Real estate, successful investing. Start early. Diversify. Be patient. Value. Pick up a rock. It is just a rock. But if it is yellow and shiny, it becomes gold. In reality, gold is not more useful than a rock. People simply consider it more valuable. For example, Steve Jobs. He created the iPhone and millions of people paid him money because he created value. Valuation. In finance, valuation is the process of determining how much an investment, asset, or financial instrument is worth. Usually 3 main methods are used: discounted cash flow method, a relative valuation method, contingent claim, option-type valuation method. Valuation in finance is needed for many reasons, such as tax calculations, inheritance and wills, division of property during divorce, analyzing a business, accounting and bookkeeping. Since the value of assets changes over time, valuation is always done for a specific date. For example, at the end of a financial quarter or year. Sometimes the current market price of assets or liabilities is calculated. This is called mark-to-market. These calculations are mainly used to manage investment portfolios and financial risk. This method is especially used in large financial companies, such as investment banks and brokerage firms. Time. Time is the most valuable asset in the world. Most people exchange their time for money, 1 hour salary. But the wealthiest people build systems that can turn their time into millions. Time is the greatest power in investing. Wealth is built not in days, but in decades. Small amounts of money invested over a long time slowly, and then quickly grow. Even people with ordinary salaries can retire with millions. They did not break the system. They simply used the system correctly.